Hi, hello, namaste, hearty, welcome to yet another interesting iLead tax talk. So, welcome back. I'm Nanda Kumar KV at iLead Tax LLC. And if you're just joining us, go back and watch episode 1 first. In that episode, I think we met Ajay, a Canadian citizen, US green card holder, and we walked through the silent years of non compliance that accumulated without him even knowing that, right? And in today's episode 2, we are going deep into 4 biggest tax traps. Okay, so these are the things that are sitting in your life right now, and most of you don't even know it. That's the irony. FBAR, FATCA, foreign interest income, and the most dreaded PFIC. Yeah, let's go. Fine. So I call this as section 2. Okay, the key tax traps. FBAR, FATCA, foreign income, and then PFIC. Okay, 4 letters that can change your financial life if you don't understand them properly. Okay, so let's take each one apart. Okay, even if you are in India also, uh, it is still foreign. Okay, so foreign does not mean Canada alone. Yeah, I know most of you know it, but still, because most of my clients, they follow the channel, they keep learning it. I also have my students from iLead Tax Academy. Hearty welcome to the students also. Foreign means anybody outside of USA. Okay, sure. Let's see this FBAR. What is FBAR and then why it matters? Chalo. FBAR. It's foreign bank accounting report. Okay, or the report of foreign bank and then financial account. So let me break this down in the simplest possible way for all of you. First, who files this FBAR? FBAR file कौन करता है? Okay, any US person who has a financial interest or signature authority over the foreign financial accounts, that person is supposed to file for FBAR. And US person means US citizens, green card holders, and resident aliens. So, if you are an H1B who has been in the USA for 5 years and you have an NRE account, you are a US person for FBAR purposes. Now, green card holder? Absolutely. Naturalized citizen, a US national? Of course. Okay, so all these people are required to file for FBAR. Now, second thing is what triggers an FBAR? Okay, the aggregate, and I want to emphasize aggregate. You getting? Say that with me. Aggregate. Okay. Now, the maximum value of all foreign financial accounts, if they exceeded $10,000 at any point during the calendar year, not just on December 31st, but on any single day. So, if your accounts combined touched $10,000 one, okay, even for one day, the filing obligation exists for that entire year. Clear? Third, where do you file this FBAR? Not with the IRS, not on your tax return also. FBAR is filed with FinCEN, Financial Crimes Enforcement Network, which is part of the US Treasury. You file it electronically through the BSA e-filing system at fincen.gov. And the deadline is April 15th with an automatic extension to October 15th. So most of the clients, they will not file this by April 15th. So you can aram se file this by the extended due date. Okay, so you get an automatic extension also by October 15th. Now next, now what accounts are included? Bank accounts, checking, savings, yeah. Then investment accounts, brokerage, mutual funds accounts outside the US, then Canadian accounts, in our case, at Scotiabank, TD, RBC, BMO, CIBC, all of them. Okay. Joint accounts, even if you are just a secondary holder, fixed deposits, GICs, term deposits, and here is one that surprises people. Even accounts where you have only signature authority count. Even if the money isn't yours, still FBAR is important. Are you getting it? So let me ask you directly, do you have any account outside the USA where the combined balance has ever been more than $10,000 even for one day? Then you may have to file for FBAR. Okay. Now I want to bring about a case law here. There is something called as Bittner versus United States. Okay, you can just Google or Gemini, anything. Okay, Bittner versus United States 2023. Okay, Supreme Court update. What it says is, for non-willful violations, penalties now apply per annual FBAR filing, not per account. Getting it? The Supreme Court recently clarified penalty structure in a case called Bittner. So this is an active area of law, and you need a specialist to assess your specific exposure. Okay, you must have, especially non-immigrants, you must have come a hard way, to the US. So I don't want you to lose your immigration status or identity for anything. Okay, especially because of these small compliance aspects and things like that. Okay, so hire a proper expert and get this done. If you can find one, one is right now talking to you. Next, the penalties. Let's talk about the consequences of not filing FBAR. And I want to be very careful here because I don't want to frighten you unnecessarily. Fear is not helpful, but knowledge is. Yeah. So let me give you the accurate picture. As you see here, there are two categories of FBAR violation. One is non-willful, right? And the other one is willful. Non-willful violation, what does it mean? Non-willful, right? You genuinely didn't know about the requirement. You made an honest mistake. You relied on a CPA who didn't advise you, who didn't understand the scope of US tax residency properly because you come from India, Canada, or from a different company. Maybe that person was an expert only from the US tax law standpoint. He did not knew how it works in Canada, how it works in India, and all. So this is the category that most immigrants fall in. The highest historical penalty for non-willful violations was up to $10,000 per violation. Now, post this Bittner's Supreme Court case, the penalty applies per annual filing rather than per account. Now, still, this area is evolving and should not be relied upon, without any specialist advice. Now, the good news for non-willful cases. See, there are structured IRS programs, the streamlined filing compliance procedures that allow non-willful taxpayers to come into compliance with significantly reduced penalty exposure. Now, we will cover this in section 4. Okay. Now, willful violation. Now, coming to willful violation. Willful violation. Okay. क्या होता? What will happen? Willful violation is a completely different animal. Okay. Willful means you know about the requirement and you choose not to comply. Or you intentionally structured your accounts in such a way to stay below the reporting thresholds, okay, or you actively concealed assets. Now in willful cases the penalty is greater of $100,000 or $50,000 of the account balance per violation. Say that, per violation. And criminal prosecution is also possible. I'm not scaring you, I'm just telling you the truth. Okay. Just to repeat, in willful cases, the penalty is greater. First thing, $100,000 or 50% of the account balance, and this is per violation. Per violation. And the criminal prosecution is also possible. So be careful. Now, the question that determines everything, are you non willful? The answer depends entirely on your specific facts, your education level, what you know, what advice you received, when you learned about the requirement, what you did once you learnt about it. So, this is why you need a specialist, not a template. Getting it? Your specific situation that determines your exposure. So, get it assessed professionally. Okay. Don't try to rely on AI. When you rely on AI, yes, I definitely, watch for it. I greatly encourage my students, my team to leverage that properly. But at the same time, just read that also that AI can make mistakes. Okay. Good to have, an expert validate your decision also. Next, let's take a quick look. Okay. FBAR versus FATCA, a side by side comparison. Okay. FATCA, Foreign Account Tax Compliance Act, and how it's different from FBAR, Foreign Bank Account Report, because confusing these two is one of the most common mistakes I see. Here is the simple way to remember it. See, FBAR is filed with Treasury, FinCEN. Now, FATCA Form 8938 is filed with the IRS, which is attached to your 1040. Both are required. Say that. Both are required. Say that once again. You also say that. Both are required, right? Because some clients tell me, नंदा जी हमने फैट का ही फाइल कर दिया, एफ बार की क्या है? It's not like that. Both are required. Getting it? Both are required. Neither replaces the other. If both apply to you, you file both. Now, F bar threshold. See, $10,000 aggregate of all foreign accounts at any point during the year. Now, for individuals living in the USA, Form 8938 threshold is like 50,000 single filer at year end, as you see here, or 75,000 at any point during the year. Now, for married filing jointly, $100,000 year end or $150,000 at any point during the year. For individuals living abroad, the thresholds are higher. Means 200,000 if he is single at year end, or $300,000 at any point. Now, if the person is married, then 400,000 at year end or $600,000 at any point. Now, you need not memorize all this. We are there for you, or you can ask Gemini or ChatGPT, anybody also. They will give you, more clarity on this. Now, what does FBAR report? Account balances. It's informational. Remember that. It's a report. It's not a tax return. Okay? Say that. It's a report. It's not a tax return. You have to remember this. You're not paying any taxes. Unlike PFIC, how you pay taxes, you're not paying taxes on FBAR or FATCA. Very important. Okay. Now, what does Form 8938 cover? specified foreign financial assets, which is broader. It includes not just bank and investments account, but also certain equity interests in foreign entities, foreign pension plans, and other financial instruments. Now, the penalty structures differ too. FBAR non-willful, it is up to $10,000 per filing historically. Form 8938 non-willful up to $10,000 plus $50,000 for continued failure after IRS notification. Very important. See, FBAR is like telling the Treasury Department, these are my foreign accounts. Now, Form 8938 FATCA is like telling the IRS, these are my foreign assets. Getting it? Foreign accounts is FBAR, foreign assets is FATCA. Is that clear? Same person, different agencies, different form, different thresholds. But both are required. Both. Which I? Both. Okay? Both are required. Now, the joint Indian accounts. See, the slide speaks directly to our Indian and South Asian community. Okay? And I want you to pay very close attention here because this is a cultural pattern, that creates a tax problem. Most people never see it coming. Okay, in Indian families and in many South Asian families, it is completely normal for parents to add their children to bank accounts, sometimes for convenience. Beta, if something happens to me, you should be able to access the money, right? Sometimes for trust, we want you to manage this account, sometimes just out of habit. Now, here is the tax problem. Tax problem. If you are added to your parents' Indian bank account, okay, parents' Indian bank account, even as a secondary holder, even if you never use that account, even if you have 0 rupees of your own in it, you may have a US FBAR filing obligation for that. I repeat it. If you are added to your parents or in-laws also, I have some clients who have nominated their daughter-in-laws. I feel very good, about those kind of people. I assume that was done in love, not by force. Now, so if you are added to your parents or in-laws Indian bank account, even as a secondary holder, so even if you never used that account, for any purposes, so even if you have 0 rupees of your own in it, you may still have a US FBAR filing obligation for that. Okay. Why? Because the FBAR requirement covers accounts where you have a financial interest or signature authority. Most people, just think about the financial interest. Okay, fine. I don't have no. Okay, fine. Okay, this is Sasurji ka, yeah, daddy ka. Signature alone, signature authority alone can trigger the FBAR obligation. Remember that. And then there is the ownership allocation question. If your parent has 80 lakhs in an account and you are a joint holder, the IRS may default it to 50-50 split of ownership, okay, unless you have documented proof of actual ownership percentage. That means 50,000 or $100,000 is allocated to you for FBAR and FATCA purposes, money that was never really yours, right? So verbal family, another warning here is that verbal family agreements are invisible to the IRS. Daddy, you remember last time अपन जयपुर में मिले थे? In that Jaipur palace, you told me this. Document ownership must be in writing, signed with the dates. Okay, so get this done before you need it. Next. Now, this $10,000 myth. Okay, let me address that a myth, that I hear, most of the time when I talk to my clients on the tax planning call. Nandaji, each of my accounts is under $10,000 individually. Okay, so I thought I don't need to file FBAR. I tell them, sir, wrong, galat jawab. This is one of the most dangerous, FBAR misconceptions. The $10,000 threshold is aggregate. It's the total of all your foreign accounts combined, not each account individually. Okay, let me show you a real example. Now, see Scotiabank Canada, $4,200. HDFC Bank India, 3,800. Then a joint family account in UK, some $2,500. Now add them up. Total comes to some $10,500. Okay, I am able to see here. So you can also do it. So is FBAR required? Yes. Even though not a single one of those accounts exceeded $10,000 on its own, you still have to file FBAR. Important. And remember, it only needs to touch $10,000 in aggregate for one day during the year, not December 31st, not year end, any single day. Getting it? Any single day. Now, see, if you have more questions, as I am explaining, please continue to watch the video until the end. If you still have more questions, ask Nanda at iLeadTax.com. Send me an email. I'll be happy to address it for you. Now, foreign interest, okay? Taxable in USA even if it is exempt abroad. Very important. Normally, with the NRE interest and all, it happens frequently, right? So, though it is exempt in that particular country, still it is taxable in the USA. That you should not miss out. Make note of that, okay? So, let's talk about this foreign interest income specifically, okay? Because this is where NRIs, including Indians and Canadians, get a very unpleasant surprise, okay? NRE account interest, okay? Tax free in India under the Indian Income Tax Act. The Indian government specifically designed this as a benefit for NRIs. But the IRS does not honor India's tax exemptions. For a green card holder or resident alien, that NRE interest is fully taxable in the USA. Every dollar of it. No exemption, no threshold, no escape. And there's another compliance dimension here. Schedule B of Form 1040 has two very important questions that many tax preparers, forget to address. There is something called as Part 3 in Schedule B. It asks, at any time during the year, did you have a financial interest or a signature authority over a foreign financial account? Means any over a financial account in a foreign country. If the answer is yes and you didn't check yes, that itself is a compliance violation. Even if the interest income was tiny. Nandaji, it was just some 1 lakh rupees only. Jujube amount. Jujube amount only. But what the law says is even if you have interest more than $10, you must report it. That's law. So take care of that. You cannot be ignoring things. The IRS states that there is no, de minimis threshold for foreign income reporting. Even $5 in NRE account is technically reportable. Okay. Now, practically speaking, $5 isn't going to cause an audit, but the principle matters. So, get into the habit of reporting everything. That's important. Okay. So, if you are an Indian client, I would very strongly encourage you to know the difference between the NRE and NRO interest, the tax complications and all. NRE, it is non-taxable in India, but it is taxable in the USA. Whereas NRO, it is taxable in India via the TDS, also taxable in the USA. Okay? NRE, remember that. E, exempt. Exempt only in one country. But NRO is taxable in both the places. Oh, zero exemption. Okay, try to remember it that way. Of course, So Nandaji, are you trying to say that there will be no tax exemption and all that? No, no, I've still not come there. Foreign tax credit may apply to NRO interest to avoid double taxation, and in case you have moved to India for good and things like that, then there is double taxation avoidance agreement also in India. You can leverage that one too. Okay, but it is definitely reportable. So don't think that it will not be taxable at all. That is something I want you to learn. Next. Now coming to something that clients don't want to hear from me. They have made me the PFIC man. Okay. And my videos, of course, many of them they appreciate, but the pain behind it, even I don't like to see you in pain. A lot of CPAs accounting firms got upset with me that I'm making all this content available online for free, killing their business and all. With all humility, I want to say, I don't care. I love my clients. I love my students. So my students are also my clients. My clients are also my students. So, and it's my responsibility as a teacher and as a practitioner. I educate my people on these things. Now, you want to charge and give this consultation for free, you're free to do that. I'm doing it for the volume I handle. It doesn't matter to us. Okay. Thank you. I respect your criticism also, but I think God has made food for everybody on this planet. The more knowledgeable you make your clients, I think more clients will come to you. Obviously, they are not going to file FBAR, FATCA, PFIC and all for themselves. No. If they are doing something like that, it would be very unwise of clients. It's like, asking me to develop a mobile application. I cannot do anything like that. So I am also an IT guy, income tax guy, but I'm not an information technology guy. So God has blessed each one of us with a different expertise, and we should work in our area of expertise. So trying to poke nose in everything, I think it's not good for clients or for the practitioners also. Okay, so please take care and don't feel offended. I think we all are doing something good. We are protecting our community in the US, and if you're working towards it, this is for you. Yeah, sure. Now, Indian and Canadian mutual funds, okay, PFIC nightmare. PFIC, passive foreign investment company. This is one that makes even experienced CPAs nervous, and it should, because the PFIC rules are among the most punitive in the entire internal revenue code. Very punitive. Let me start with the basic definition. See, a PFIC, I think I made some 6 episodes or something, uh, but still, I encourage you to get a revision of that if you have not watched them, because it will help you to guide somebody else at least. Okay, and then if you have more questions, you can go back to your accountant, or we are also always there for you. So, a PFIC is a foreign corporation where 75% or more of its income is passive income, like interest, dividend, capital gains, and all, or 50% or more of its assets produce passive income. So, most foreign mutual funds, say the Indian mutual funds, Canadian funds, foreign ETFs, they qualify as PFICs. Now, your Parag Parik Flexi Cap SIP, PFIC. Your DSP Top 100 Fund, PFIC. Your Canadian TD Comfort Fund, PFIC. Now, here's where it gets painful. Under the default PFIC taxation rules called the excess distribution rules, any gain or distribution from the PFIC is not taxed as a capital gain. Instead, it's allocated back across your holding period, taxed at the highest marginal rate for each year, plus an interest charge for each prior year. The effective tax rate can exceed 50% also in some cases. And I have seen PFIC tax bills that were larger than the entire value of the original investment. But there are elections that help. Okay, mark to market election. You pay tax on the annual increase, in value, as ordinary income each year, but avoid the punitive excess distribution calculation. Okay, there's something called as QEF election, means qualified electing fund. It treats gains as capital gains, but it requires annual information statements from the foreign fund, which most Indian funds do not provide. You know how our mutual fund agencies work. And here is the thing: Form 8621 must be filed for each PFIC annually. Each PFIC annually. Even if you had zero distributions, even if you didn't sell anything, even if the value didn't change, the filing obligation exists. So, if you have Indian mutual funds or SIPs, whether Mire, Axis, HDFC, Parag Parik, SBI, it's very important, that you get a consultation on PFIC. Okay. I don't want to tell you to simply stop the SIPs, without professional guidance, but the act of selling a PFIC while it's in default PFIC treatment can itself trigger a massive tax event. Okay, so I greatly recommend that you get a tax planning session from somebody you can rely on. Hmm? Now, the FATCA letter that changed everything. Let me tell you, about the moment everything changed for one of our clients, Ajay. And I want you to notice something important here. It wasn't an IRS agent knocking on the door. It wasn't a penalty notice either. It wasn't an audit letter also. It was just an ordinary piece of mail from his bank. Scotiabank sent him a standard letter, routine communication, informing him that his account information had been reported to the IRS under FATCA, the Foreign Account Tax Compliance Act, and his account balance under $10,000 USD. Not a large account, not suspicious, just a normal Canadian bank account. But that letter triggered weeks of panic, weeks of self research, at 2 a.m. in the night, searching Google, ChatGPT, Gemini, or whatnot, reading IRS publication, online articles, finding conflicting advice on Reddit, growing fear, growing anxiety, and then eventually landing into our videos. Thanks to YouTube, when they were searching, they got my video. Now, here is what I wanted to tell you. See, FATCA works through the banks, not through you. Okay? FATCA works through the banks, not through you. Now, under FATCA, signed into law in 2010 or something, effective from 2014, foreign financial institutions are required to report information about US account holders to the IRS. Now, this Scotiabank, HDFC, SBA, Axis, TD, RBC, they all have FATCA compliance programs. They identify US persons among their account holders and report that information directly to the IRS. Now, without telling you in advance, without asking your permission also. So, even if you never file FBAR, even if you never filed FATCA Form 8938, the IRS may already have your foreign account information sitting in their database reported by your bank itself. That's why proactive disclosure is so critical. The IRS already knows more than you think. कानून के हाथ लंबे होते हैं. No, it's a very dry topic. Okay, so I add a little humor. Okay, sorry if it irritates you. Now, how a small local CPA missed a massive international issue. I want to address something that I know makes some of my peers uncomfortable to talk about, but I have to say it because it's costing immigrants money. Local CPAs, and I want to be very respectful here, local CPAs are often excellent at what they do. They handle W 2 returns, deductions, retirement contributions, state taxes. They're very competent professionals, but cross border taxation is a specialization. It's not just a different set of forms, it is completely different discipline. It requires knowledge of FBAR regulations under the Bank Secrecy Act, FATCA under HIRE Act 511, then PFIC rules under IRC sections 1291 to 97, the US Canada Tax Treaty, FinCEN guidelines, then IRS streamlined procedures, dual status return methodology, foreign tax credits baskets under section 904. So this is not, standard CPA curriculum. At iLead Tax Academy also, we teach all these courses, EA, CPA, partnered with somebody and all. But this is very practical. Getting it? I don't mean to say that Ajay's local CPA was negligent. Ajay's local CPA just didn't know what they didn't know. They never had to deal with FBAR. They had never prepared a Form 8938. They had never seen a PFIC Form 8621. Probably after this video, they start researching how this form. Oh, Nuena. Is that you? And because they didn't know to ask, they didn't ask. And because Ajay didn't know to volunteer the information, he didn't volunteer it. The lesson here is, if you have foreign accounts, foreign income, foreign property, or you were a non resident for any part of your US tax residency, you need a cross border specialist, not a generalist. Getting it? Cross border tax is like cardiac surgery. You wouldn't ask your family doctor to do it. Getting it? Oh, we know that brother from last 10 years. Good. Praise God for that brother. But go to a cardiologist. Okay. Same principle applies here. He is good doctor. Anytime there's an emergency, he comes home. Very good. Good person. But specialist, you need a different person. Okay. Now, the PFIC dilemma, compliance cost versus the practical risk. Now, I want to share something with you that most tax educators don't discuss publicly because it's nuanced and nuance is important. The legal reality is clear. Okay, if you hold a PFIC, you are required to file Form 8621. That's the law. Khatam baat. If you hold a PFIC, you are required to file Form 8621. That's the law, full stop. But here's the practical dilemma that comes up in my, I plan tax planning consultations. Now that the phase 1 planning is ending by June 30, I keep getting this often. See, when a client has a 5,000 rupees per month SIP that they started in 2018, and it is now worth rupees 8 lakhs or 10 lakhs, let's say, about $10,000. The cost of professional Form 8621 preparation, mark to market election, and excess distribution calculations could realistically be 1,500 to $3,000 per year. Getting it? $15,000, $1,500 to $3,000 per year from a qualified specialist, more than the actual tax liability. Okay. But does that mean you can skip the filing? No. The filing obligation exists regardless of the size. But it does mean that a cross border specialist needs to weigh your compliance cost against your actual exposure. So, document the analysis and it will help you, make informed and then defensible decision. And that's very different, from just ignoring it. Now, what I typically advise my clients is small PFICs, with de minimis value, document everything, get professional guidance, and develop a strategy. Larger PFICs, compliance is non negotiable. Get Form 8621 prepared properly. And going forward, consider whether holding foreign mutual funds continues to make sense given the compliance burden, or whether repositioning it into US domiciled funds is more practical. Okay, so this is a very specialist level conversation. So get better professional guidance before you make any decision. Okay. So now you know the four big traps: FBAR, FATCA, foreign interest, and then PFIC. But we haven't even gotten to the one that hit Ajay the hardest: the home sale. The home sale, okay? The $300,000 Canadian dollar gain, the exchange rate shock, the Section 121 exemption, and the reason why tax free in Canada doesn't mean tax free in the USA, okay? So, in the next episode 3, we will be going deep into real estate, foreign home sales, currency conversion, Section 121 planning, and a complete case study calculation. Okay, so if you own property abroad or you're thinking about selling one, episode 3 could save you tens of thousands of dollars. Subscribe now to iLead Tax LLC, hit the bell icon, share this with anyone you know who has a foreign property or accounts, and I'll see you soon in the episode 3. Okay, this is Nanda Kumar KV at iLeadTax.com. See you soon in the next episode. Take care and have a wonderful weekend ahead. Love you all.